Hey, this is Brian Kurtz with PremierRealEstateInvesting.com. We're back at you with another episode of our series entitled Funding Fundamentals, where we're going to talk about how you can find all the money that you need to fund your real estate investing deals so you can build a multi-million-dollar real estate investing portfolio. All right, today's episode we're going to be talking about hard money. And hard money is an awesome type of financing. It is a mainstay that has been around for years and years and years that investors have always tend to flock to in order to go ahead and get their financing set up for their particular investments. Now, let me just give you an overview of what hard money is. Hard money does not mean that it's hard to come by. What hard money means is that it comes with hard terms, or it's expensive. So the typical hard money loan is going to, first of all, be very conservative. So it's going to have a very low loan to value. If you have a house that's going to be worth $100,000 fixed up, they're probably only going to be willing to loan maybe somewhere between 55 and 65% loan to value. So $55 to $65,000 would be in that particular scenario. Now that's a much more conservative type of loan than, say, conventional financing. Conventional financing will do 20% down, 25% down, and hard money makes it sound like you have to put down, I don't know, 35, 45%, 50%. That's not actually the case. Hard money is ruled by a different set of rules. They base that loan to value on the appraised value, not the purchase price. So, for example, let's say that you were going to be able to find a house that didn't need any work and you were going to get it for $55,000, and it would appraise in today's market for $100,000. On a conventional loan, they would say, okay, you know what, the appraisal comes in at 100, but you're buying it for 55. Here's the thing, we're only going to give you 80% loan to value, and we're going to base that on the purchase price, not the appraised value. So yeah, the house is worth 100, but you got to put 20% down based on that value that we said, 55. Now that would be 5,500 would be 10%, and that means that you need to put down $11,000 in cash. Even though you're getting a great deal, you still have to come up with 11 grand. Let's do that, okay? Hard money guy doesn't think that way. He says, all right, let's see. House is going to appraise at $100,000, and I will loan you 55% loan to value, which would be $55,000. That's it. They based on appraised value. That is what a hard money loan does. Now, I am going to have to say, the one thing that really ticks me off is the real estate investing courses out there that just gloss over the whole financing thing, which is a huge, huge issue, because if you can't get the money to buy a property, it doesn't matter how great of a deal you're going to get. It just doesn't matter. You're not going to be able to buy it and rent it out if you can't get access to the money, right? So you'll read these courses, and they'll have like 3 pages in there that talk about where to get the money, and they'll say, hey, if you got bad credit and you don't have any money, don't worry about it. Hard money lender will take care of you, because they loan on the value of the property and they don't care about your credit. In fact, you can sometimes even get this all taken care of without even a credit check. How wonderful is that? Bing! Solve that little problem in 2 pages, right? So you got a 200-page course. 2 pages are dedicated to how to get the financing for your deal, and it says just hunt down a hard money lender. Ask somebody at your real estate investing group. You'll find one, right? You'll be good to go. Here's the problem. Hard money has changed. And you can ask anybody at your real estate investing group, and they're going to tell you it's changed. And in fact, for the most part, hard money is turning more into traditional lending, and they are having their own set of underwriting guidelines. They almost always will pull your credit report, and hard money is really looking for good credit now. So they're pretty much, what I'm hearing is, if you don't have 680 credit score, 680 middle FICO or whatever, or better, you're going to have a hard time getting hard money financing. These true what we call equity-based lenders, where they will only lend based on the property. They don't care about you at all, because if they have to take the property back, they know they can get such a better deal for it just by selling it. They are almost non-existent. So I'm not even going to tell you to try to hunt those people down, because it's like this futile nightmare of an experience trying to hunt those types of hard money lenders down. Furthermore, hard lending is not really my preferred funding source, because it's very expensive, and you can get just as creative types of investing programs from other sources. Some of the other ones we're going to talk about in the future episodes in this particular series. But for example, hard money lenders are going to usually charge 4 to 5 points up front. Now either you're going to make you pay those cash at closing, or they're going to roll them into the loan. Doesn't really matter. Either way, it's real money coming out of your pocket in the end of the deal. So they're going to charge 4 to 5 points up front, and they're also going to charge an average somewhere between 14 and 15% in interest rate, depending on whatever state you're in. And there's certain states have rules about what you can charge and all that. But for the most part, you're going to be paying 14-15% interest rate, which is very high. You're also going to have typically a 1 year, either a 6 month, 9 month, or a 1 year, 1 year being the most common, balloon. So you got to get into the deal. You got to take care of your business, fix it up if you have any fix up in there. You have to go ahead and put somebody in there as a tenant, and you need to refinance out of the property as soon as possible, right? Well, if you remember from our conventional financing side of things, if you are trying to lean on that to refinance you out of the hard money loan, it can be kind of problematic, especially once you get 4 properties or more. So I'm not saying you can't do it. I'm saying you got to be kind of creative in how you do it, and that it may be a little bit more difficult than the people that write the books and the courses would have you believe. So hard money is a feasible source, but my question to you would be, if you can get the same type of benefits that hard money provides, namely that they lend on the appraised value versus the purchase price, they will give you money for your rehabs and closing costs as long as it falls within that whatever the loan to value guidelines is. If you can get that same type of benefit without paying 4 points and without paying 15% interest, why wouldn't you? I mean, wouldn't you go with the cheaper money? And the fact of the matter is, most people don't know where to look for it. That's what it is. They read the course, it says hard money, they go look for hard money. They latch on to the first thing that they can see, and even if it's a blood-sucking leech who's going to suck all the equity out of the deal, I mean, there's plenty of people who say, hey, I get to the end of the deal and I sell it, the hard money lender made more money than me. You don't want that story. That's not your story. You don't want to have that story. So you want to be the guy that makes the majority of the money, which means you need to get financing that you can get with pretty much, the big one is far less points, like as in 0 points or 1 point max, and interest rates that are 12% or less. So as long as you can get funding that will let you buy the house, will let you fix it up, and will cover your closing costs, and you probably should find a way to go ahead and do that the cheaper route. So hard money, pros and cons, let's go over them real quick. Pros are that the lending restrictions are much less than conventional financing. You don't have as much issues with you have to put so much money down because they base on the appraised value versus the purchase price, so that's a huge benefit there. And they are lending on investment properties. They're not trying to kill investment property deals like you will get with oftentimes with conventional financing. So those are the pros to hard money. The cons to hard money, the negatives, the takeaways are very, very expensive, and sometimes it can be problematic jumping through hoops to get your actual funds for the rehab. So hard money, that's pretty much sums it up for that subject. Should have enough information to go with on that. In the next video, we're going to talk about one of my favorite funding sources, if not my very favorite funding source, which is private money. Private money is an awesome, awesome way to go ahead and take care of your business, where getting the funds for buying great real estate in this awesome environment is concerned, and we will definitely be going very much in depth into that in the next episode. I will see you next time. Thank you for watching our real estate investing show.